In this video, we're going to talk about the 4 best ETFs to combine with SCHD to get rich faster. SCHD is what many people would argue as one of the best dividend ETFs on the market, and for good reason. It's an ETF that tracks and invests in the same companies as the Dow Jones US Dividend 100 Index. And what makes SCHD stand out is the fact that it has a great dividend yield of around 3.5%. It's also had some amazing dividend growth, with its dividends increasing year after year for 13 consecutive years now, which is more passive income for you every single year. And it's had some nice returns of around 14.5% over the past 5 years and almost 11.5% in the past 10 years. This combination of great dividend income, dividend growth, exposure to stable companies, along with the great return that it's had, shows that even on its own, SCHD can be a good choice. But I have 4 different types of ETFs that you can pair with SCHD to really boost your portfolio and get the added benefit of things like more diversification through the addition of more stocks and sectors, the opportunity for more growth through price appreciation, or increasing your passive income by getting more dividends. Now, before talking about these 4 ETFs, there's an important term that I want you to understand and be aware of when investing in different ETFs, and that's portfolio overlap. Simply put, portfolio overlap or fund overlap is when 2 or more of your ETFs in your portfolio share the same stocks or other assets. To give you a better idea when comparing the Vanguard S&P 500 ETF VU and the Vanguard Total US Stock Market ETF VTI, there's 87% overlap, meaning they both hold a considerable portion of the same stocks, and in this case, your best bet is to go with one or the other. Too much overlap between funds can lead you to have too much concentration in certain stocks and sectors of the market, while a low fund overlap gives you more diversification by being able to spread your risk across different assets and sectors, decreasing concentration in holdings or sectors, along with the opportunity of more growth potential due to having more exposure of other segments of the market. So the first type of ETF to add with SCHD is a growth ETF. Now there's a variety of great growth ETFs that can work well with SCHD, and I'll list some of them that you could also pick here. I chose SCHG, which is the Charles Schwab US Large Cap Growth ETF. The goal of SCHG is to track the performance of the Dow Jones US Large Cap Growth Total Stock Market Index, so strictly large cap companies. When it comes to the fund overlap, as of this recording, SCHD and SCHG have no overlap at all, so neither of these funds hold the same stocks, which means these ETFs can work as a great combination together. And if we take a look at the top holdings of SCHG, you have companies like Apple, Nvidia, Microsoft, Amazon, Meta, and these holdings make up around 55% of the fund. And this fund contains a total of 229 holdings. For the sectors that make up SCHG, the primary one is technology at nearly 50%, followed by communication services and consumer discretionary. Considering technology and communication are 2 sectors where SCHD doesn't offer as much exposure to, by combining these 2 ETFs, you would now give yourself exposure to these high growth stocks and parts of the market that offer more potential for larger returns and growth for your portfolio, while also exposing you to more of the market as a whole. As for cost, SCHG has an expense ratio of 0.04%, meaning you'd be paying $4 for every $10,000 invested. Moving over to the dividends for SCHG, it has a dividend yield of around 0.4%, so quite low here, which is expected for a fund that's geared towards growth. But on the plus side here, pairing this fund with SCHD will allow you to still benefit from the nice dividend yield that SCHD offers, along with its stability, giving you that nice balance combined with the opportunity for more capital appreciation that comes with SCHG. Speaking of appreciation, SCHG has shown some great performance with annual returns of over 20% in the last 5 years and nearly 16% over the last 10 years, which would be over 300% in gains over those 10 years. And if we look at this chart comparing this fund with SCHD over the last 10 years, you can see how much more price appreciation that SCHG had offered. I think this goes to show that having a growth ETF along with SCHD will allow you to take advantage of the opportunity for amazing returns that can come from being exposed to growth while also collecting a nice dividend. and by having those value-focused funds and added diversity from SCHD that helps to balance out the portfolio from SCHG's heavy reliance on the tech sector. This next ETF would be a S&P 500 ETF or some type of broad market ETF. Here are some choices which you can't really go wrong with since there are many good ones to pick from. The ETF that I chose and invest in on a regular basis is VU, the Vanguard S&P 500 ETF. If you don't already know, this ETF tracks the S&P 500 index, which represents the 500 largest companies in the US. Also, keep in mind that the S&P 500 makes up roughly around 80% or so of the total US market cap, so these companies really have an effect on how the overall stock market moves. When taking a look at the fund overlap between VU and SCHD, it's pretty low at just 7%, which is good news. VU currently holds around 505 stocks, and its top holdings include companies like Apple, Microsoft, Nvidia, Amazon, Meta, and Google. The top sectors for VU are technology, financials, consumer discretionary, and the remaining are spread in a variety of other sectors. The broad range of holdings, along with the broad diversification that this fund has, putting it together with SCHD makes for a very solid combination. With SCHD, you're investing in only value stocks, but with VU, you have exposure to both value and growth stocks, giving you more opportunity for higher returns when growth is outperforming value. For the fees, when it comes to VU, this fund has a low expense ratio of just 0.03%, meaning you'd be paying $3 for every $10,000 invested. And VU has a dividend yield of around 1.2%, which is pretty good. If you're combining this with SCHD, you'd still be managing to have a yield of over 2% in your portfolio. VU has also had some impressive results in performance, with average annual returns of over 16% in the last 5 years and just under 13% in the last 10 years. Because of that, it's a nice addition to have with SCHD, even if you're looking to have just a two-fund portfolio setup. For example, if you invested $10,000 in these two ETFs 10 years ago, you'd have over $31,000. And you could even choose to incorporate a growth fund like SCHG to make a three-fund portfolio, which if you split 3 ways, that same $10,000 investment would be worth over $35,000. I think it's important to have some type of core foundational fund in your portfolio, as it can complement well with the variety of portfolio strategies due to its nature of being more broad and diversified. This third ETF is going to be a covered call high-yielding dividend ETF. Here's a list of a few popular high-yield ETFs that you can also look into. But I went with JEPI, which is the JP Morgan Equity Premium Income ETF. If you're wondering what a covered call ETF is, to keep it simple, this is an ETF that generates income by selling call options on the stocks or other assets it holds, then collecting a premium from those option sales, which are then distributed to investors as income. The fund overlap between SCHD and JEPI comes in pretty low at only 8%. Again, this is good to see. JEPI contains a total of 129 stocks, with its top holdings in companies like Visa, MasterCard, Progressive, AbbVie, Meta, and Amazon. The top sectors JEPI is exposed to include financials, technology, healthcare, and industrials. As for the cost, JEPI has an expense ratio of 0.35%, meaning you'd be paying $35 for every $10,000 invested. Now, for the dividends, JEPI has a dividend yield of 7.3%, which is really high, as well as it pays out its dividends monthly. Although this dividend yield is pretty amazing, there are some things to consider here. While JEPI provides a nice dividend income, on its own, it really lacks in dividend growth, as well as it sacrifices some of the upside and capital appreciation due to its strategy, since that dividend income fluctuates based on the volatility of the market. Where SCHD comes into play here is that it makes up for the lack of dividend growth along with capital appreciation, and together they double down on providing you with great dividend income. That being said, since JEPI was created in 2020, it's had annual returns of over 12.5%. If you're looking for some high dividend income, these two paired together can definitely get the job done. And while there are other options for higher yielding covered call ETFs that may also have more potential for appreciation, I believe JEPI offers a bit more stability here than some of those others, which could be a nice choice to consider for someone looking to live off dividends. The fourth ETF is going to be a dividend ETF. So in the same category as SCHD would fall, and that doesn't mean that they are exactly the same, as there are a lot of great dividend ETFs and they can vary in strategy of focusing on income or growth. The choice I went for here is DGROW, which is the iShares Core Dividend Growth ETF. This ETF is made up of stocks that have a history of growing dividends yearly across a variety of industries. The fund overlap of DGROW and SCHD is around 16%, which is the highest on this list, but it isn't a big deal when you take into account that these are two ETFs with a variety of dividend-paying stocks. DGROW contains a total of 411 holdings, with top holdings in companies like Johnson & Johnson, AbbVie, JP Morgan Chase, Exxon, and Apple, along with its top sectors being financials, healthcare, and technology. And you might be thinking, well, what would be the point of having more than one dividend ETF in a portfolio? Well, for whatever percentage of your portfolio that you decide to allocate for dividends, it doesn't have to be in only one ETF. In the case of having DGROW with SCHD, you're just further diversifying your dividend portfolio by being exposed to a wider variety of stocks and sectors and increasing your potential returns. And whether it's DGROW or the many other dividend ETFs, you can better tailor your strategy by picking what ETFs suit the goals you're looking for. Now, getting into the cost, DGROW has an expense ratio of 0.08%, so that would be $8 for every $10,000 invested. The dividend yield of DGROW is 2.1%, which it pays out quarterly. And while this may not be a sky-high dividend yield, the consistent dividend growth that this ETF offers gives the opportunity to provide an increasing stream of income year after year. DGROW has also had great performance with annual returns of around 14% in the last 5 years and over 11.5% over the last 10 years. If we compare this to the performance of SCHD over the last 10 years, you'll see that DGROW just barely edges out higher. But outperformance isn't the key factor here. It's more so increased diversification, less volatility, and higher dividends and dividend growth. And if you're interested in learning about some other great dividends, be sure to check out this video here. Let me know in the comments below if you own any of these ETFs mentioned, or what ETFs you think make a great combination with SCHD. As always, I appreciate you watching, and I'll see you in the next one.